So learning from mistakes can be painful. Yet, as Carnegie said, the successful man would profit from his mistakes and try again in a different way. Albert Einstein went even further and was quite blunt when saying the definition of insanity is doing the same thing over and over again but expecting a different outcome. It's never too late for you to adopt a measured approach to investing. Now let us help you with better financial planning through learning from some of the common mistakes that people do. 1. Investing too late and without an objective. Over time, capital markets offer better return than putting your money in the bank. So the sooner you start participating, the better it is for your longer-term investment goals. That said, before you invest, you should have some idea about the objectives of your investment, whether it's your children's education, that ideal living standard, or your retirement. Therefore, it's really important that you set clear investment goals. It'll be much easier for you to be on track rather than being distracted by rumors and market sentiment. Number 2, over-concentration. Do not put all your eggs in one basket. If your overall portfolio only contains one type of asset, then the risk level may be unnecessarily increased. Instead, consider diversification. This strategy doesn't ensure profit, it doesn't guarantee that you won't lose money, but you can better manage risk by spreading your assets among different investments and asset classes. That includes stocks, bonds, cash, across regions, sectors and styles. Number 3, being too emotional and trying to time the market. I know all of us would like to be that wizard investor who buy low and sell high as to gain the most return. Unfortunately, empirical studies show that we do the complete opposite. So putting in place a framework that acknowledges and mitigates these shortcomings is very important. There's an important term here called dollar cost averaging, and that is the concept of buying a little bit at a time, spread out over a longer period. You won't be able to buy all your assets at the lowest price, but nor will you pay top dollars. The important thing is that you keep buying, adding to your investment portfolio. Impatience can be costly too. Over time, the value of a company is derived from the profit and the cash flow it generates. That said, it might take months, if not years, for that correlation to materialize. In the short term, prices are affected by other factors, such as market sentiment, liquidity, competitors' actions, or political events. These events are notoriously difficult to predict, but in the short term they move assets, and sometimes really large. However, trying to move your portfolio in response to these events is something that even the professionals find very difficult. Listening and learning from your friends and family is important in life, but when it comes to the complex task of investing your money, you might be better off listening to a professional instead, as you would seek the help of a qualified doctor if you're ill, and not only listen to your auntie.